A very good afternoon, ladies and gentlemen. My name is Monica Kamundi, aka Magical. I change people's lives by offering financial advice and financial solutions. It is said that measure your coat according to your cloth. In our previous conversation, we spoke about the money market, which is one of the funds under the collective investment schemes, or what we call the mutual funds. So, because you and I are different, different investors have different objectives, they have different risk appetites, and it's for this reason that we need to offer variety for people who want to invest. And for that reason, today we will be having a look at the equity fund. So the equity fund, just as the word suggests, invests in equities. Equities are stocks. So equity fund is a fund that primarily invests in publicly listed shares, shares of publicly listed companies. So this is a fund that is ideal for investors with a high risk appetite. Investors who can be able to ride the ups and downs of the stock market, because the reality is that the stock market is volatile. It goes up and down. Prices of shares will change every day, and hence it's important that before you start investing in the equity fund, you are a high risk appetite kind of a person. The other thing you need to put into consideration is that you need to have a long time horizon. It is recommended that you have at least a time horizon of 5 years and above for you to invest in the equity fund. This gives your money time to go through the different economic times, and then you're able to have your money grow over the years. And your money is able to grow through capital gain and dividends. Capital gain is a scenario, for instance, if you buy a share at 20 shillings, and then in the next 1 year you sell it at 100 shillings, that is capital gain. So your money has the potential to grow exponentially over the years. So in as much as the equity fund is high risk, the potential of the returns is also quite high. So the key thing is for you to understand the fundamentals of investing into the stock market. Understand that the stock market is volatile, and as long as you have a long-term horizon, you are able to benefit from that growth on your money. Your money is able to grow and beat inflation. So equity fund is ideal for people who are looking at diversifying into the stock market. Because if you, as a single investor, you want to buy shares from various companies, you might need quite a lot of capital to do that. But in the equity fund, with a minimal amount of money, the fund manager is able to distribute your money in various publicly listed companies. Hence, you benefit from that. So, thing is, the fact that you can access money in the equity fund also becomes an advantage, because, as we said earlier, another opportunity might rise up, and you need to take to take opportunity of that investment option that has come up. So you can access money from the equity fund because it's not a contractual investment. It's open-ended. So sometimes you realize you've already broken even, or the return on your investment, you've already achieved that. So you can actually access or redeem your investment because it's not a contractual kind of an investment. So, ladies and gentlemen, it's just important for you, before you put your money in any fund, and especially the equity fund, it's important to ask yourself a few questions. Number one, ask yourself, what is my risk appetite? Am I a risk taker, or am I risk averse? If you're a risk taker, then you can get into the equity fund. If you're risk averse, then I would suggest that you put your money in the money market fund. The other thing you need to find out is, what is your time horizon? Do you have enough time to leave your money in the equity fund? So if your time horizon is 1-2 years, I wouldn't recommend for you to put money in the equity fund. The other thing you ask yourself, what is the goal? Because the goal then determines, is the goal to have an emergency fund, or is the goal to grow your capital over the years? If your goal is to have an emergency fund, then the equity fund might not be the ideal place to put your money. You might want to save that money in the money market fund. Also, ask yourself, do you have cash flow? Do you have enough money to take care of your day-to-day expenses? Because if, for instance, you have your 100,000 and that is the money you're expecting to take care of your monthly bills with, for instance, pay for school fees, pay your rent, pay for the utilities, then I wouldn't recommend that you put that money in the equity fund. So asking yourself a few of those questions, you're able then to decide, is this the kind of investment you want to get into, or is it a different kind of investment you need? So, ladies and gentlemen, I repeat, measure your coat according to your cloth. Thank you for watching. Thank you for joining into the conversation. Have a lovely afternoon. Thank you.